discuss their interim results, I'm joined by Andrew Bell, Chief Executive of the Witan Investment Trust. So Andrew, let's start with the key contributors and indeed detractors to the company's performance.
The first half of 2018, the markets overall didn't make a lot of progress. Our benchmark was up just under 1.1% and our NAV total return was up just over 1.1%, so pretty much in line. And the main drivers of that were that most of our managers outperformed their respective benchmarks, some by a little, some by a lot. We had a little help from being geared during the period, and that, broadly speaking, was offset by costs during the period. So we performed fairly much in line.
And how would you say global equity markets have performed over the first half of 2018?
Well, there was a lot of activity, a bit like a swan serenely paddling across a pool. There's a lot of activity underneath. There was an enormous amount of optimism in January on the back of the US tax cuts, acceleration of growth at the end of 2017. And then it all slightly boiled over. There were worries about inflation picking up. A few hedge funds blew up in late January. And then we had an eruption of worries about trade policy coming out of the US, worries about a trade war. The oil price went up because of problems in Venezuela and disputes between Iran and the US. And as a result, the markets were a bit choppy for the rest of the period and gradually began to recover in June. But otherwise, the mood was very different for most of the period from the optimism in January.
Witan employs a multi-manager approach and is currently invested with 10 managers. So can you describe the performance of your underlying managers?
It was relatively varied. A notable positive feature was that our 3 UK managers outperformed the UK market quite substantially. They gave returns of between 4 and 7%. One of our global managers rose by about 3%. The direct holdings portfolio was up by about 3%, and the others were various slightly smaller numbers. Those don't sound very exciting numbers. They're not telephone numbers, but in the context of really flat markets, those were the highlights. And there were a couple of underperformers, but nothing very substantial.
Well, as well as external managers, Witan's executive investment team can also invest up to 10% in specialist collective funds, and since the start of this year, up to 2.5% in smaller investment mandates. Now, this portfolio rose by 3% in the first half of 2018, beating the benchmark. So what's the portfolio invested in?
Well, the direct holdings split into 2 packages, as you indicated. There's up to 10% can be put into collective funds. And at the end of June, we had just under 9% in that area. Most of it was invested in listed private equity, which has done very well for us over the years, and a couple of specialist healthcare funds. We're also able to invest, which is a novelty, innovation in 2018, up to 2.5% in less well-established managers or more specialist managers where we think they've got quite good potential over time. And we did make an investment with a company called Latitude during April, where we've allocated just over 0.5% of our assets to them to invest in global equities.
Have there been any further changes to the portfolio this year?
We've made minor adjustments as between one asset class and another. We sometimes switch from global to UK or vice versa. But there were a couple of other features. At the beginning of the year, we had a futures position in European stock index futures, and we sold that down and invested the money in our 2 European managers because we generally prefer stock picking to buying indices. And then towards the end of the period, we sold some futures during late May because we were beginning to become a little bit edgy about the trade policy, threats of trade tariffs coming out of the US, about the rise in the oil price. And the markets had a decent recovery, so we sold about 1% of our assets short. And then as the mood began to stabilize during June, we closed out that position for a small profit. And then just more recently, since the period end, we've been adding gently to our emerging market exposure, emerging markets having been among the weaker areas in the first half of the year.
And moving on to gearing, why do you use gearing and what's your strategy?
Well, the purpose of gearing is that if you can borrow at a rate that's lower than the return that you get by investing the money, then you can amplify returns for shareholders. And in a rising market, that amplifies gains. You always have to remember that in a falling market, that can amplify your losses. And so what we try and do is to ensure that we have more gearing deployed in or invested in the markets when the markets are rising or when we hope they're going to rise, and then we tend to reduce gearing into market rallies. And that, broadly speaking, is what we've done during the first half of the year. Although the gearing didn't change a lot from the 10% it started and ended the period, it fluctuated by 1 or 2 points, and we tended to buy on weakness and sell into strength.
What is Witan's dividend policy?
Witan's policy on dividends is that we aim to increase the dividend ahead of inflation year by year by year. And over the last 43 years, we've raised the dividend consecutively every year. And that's something that we hope to be able to do in the future. But obviously, we can't promise it. It depends upon the success of our underlying investments. Our policy on dividends paid within the year is that we pay 3 quarterly dividends in June, September and December at a rate of a quarter of the previous year's dividend. And then in March, we declare a 4th dividend, which is the difference between what we think we can pay for the full year and what's already been paid out. So we paid a 5.25 pence per share dividend in June, and we're declaring a further 5.25 pence dividend with these results, which will be paid in September.
Well, finally, what's your outlook for global equities for the rest of 2018, and how are you positioned to take advantage of the opportunities?
We're cautiously optimistic, despite the toing and froings and the policy uncertainties. There are always economic and political uncertainties. We've got the risk of a trade war, we've got the oil price, which is still not quite sure whether it's going to go up or down, and we've got Brexit coming in and out of focus locally in the UK. But the markets have been used to those. Very largely, they're watched pots, and unless they deteriorate significantly, we think there's at least as much possibility of a positive surprise if they're less bad than expected as of a negative surprise. And in the meanwhile, during the first half of the year, the markets have gone broadly nowhere, and earnings have grown. So markets are cheaper than they were at the end of the year. Sentiment is less complacent. So we're fully invested. We're approximately 10% geared. We're probably looking for better returns out of the markets away from the US. The US is clearly growing very strongly. It's got lots of very exciting companies, but we think that the joy is going to spread to other areas which have held back in the first half of the year, such as Europe, such as emerging markets, and even the poor old UK, which as a result of the political uncertainties over Brexit has become much more cheaply valued relative, for a globally exposed market, become more cheaply valued than it has been historically.
Andrew, thank you.
Thank you.